Hey guys, so today in this video, what I'm going to be doing is I'm going to be covering risk, what risk is, and I'm going to go into like the different metrics of risk. I see a lot of people online talking about risk. I don't think a lot of them are aware how to quantify risk. So let this video serve as an introduction to risk. Of course, this is a simplified version of kind of risk entry introductory course. Risk goes a lot more in depth. This is just kind of what you would need to know as a retail trader or investor if you want to kind of have a good idea of what risk is. So starting off, we got to answer the basic question. What is risk? So risk, simply put, it's going to be, I'm going to make myself a little bit smaller here. So risk, simply put, is just the variance or volatility in the price of the asset. So assets have different prices, even though it's the same asset. One asset can be worth $100, but the next minute it could be worth $105. The rate at which that price changes, that difference, that variance is what is risk. So typically when stocks or certain assets, not only stocks, this applies to anything, have higher returns, they also tend to have higher risk. Because you think about it, let's say you buy something, it goes from 100 to 200 in a short time period. That's very risky, but it's also very rewarding. So yeah, as you can see here, higher variance is a higher changes in price, but it also means higher returns as well. So for example, in this case, we have Bitcoin versus the S&P 500. As you can see, the Bitcoin chart, even though it's a lot more volatile, you can see huge like peaks and drops. It did outperform the S&P 500, but of course it has more risk. And there is a great question here to kind of get you thinking in the mindset of an investor or trader, what you should do when you consider risk. One of the main questions you should ask yourself is, say, if you got 10% from SPY versus 10% from Bitcoin, which one is better? Now, this isn't really a rhetorical question. You got 10% in both. You put in $100, you got 110 out of both. But in this case, you think about from the aspect of risk, getting 10% from SPY is superior than getting 10% from Bitcoin, because even though you got the same return from both, because SPY has less risk than Bitcoin. For example, SPY's volatility on an annual basis is about 10 to 20%. Bitcoin, it could be over 100%. Because you have less risk with SPY, it's better getting that 10% return from SPY than that 10% from Bitcoin, even though at the end of the day, it's the same return. And that brings us into our next concept, which is variance and volatility. So variance and volatility both measure risk, but they're both a little different. Sorry, let me move my way out. So let me move myself out of the way. So for example, they both measure risk, but they're both a little different. So what variance measures is the price's distribution, or the standard away from a standard deviation. So the price within the time period is going to have a mean. That distance from the mean, that is variance. But volatility is purely just the difference in price. So it's kind of very similar. Volatility typically is what you want to be looking at as just a retail trader. It's what's going to tell you the differences in price, but variance tells you how different the price is from the mean within a time period. So for example, this is the volatility formula. As you can see, it is the square root of sigma squared, whereas variance is just sigma squared. So they both rely on standard deviation, which is going to be the next thing we talk about. But just take a second so you can kind of get this idea. Volatility is the difference in price, and here is a high volatility stock. This is the chart for Tesla. And as you can see, Tesla has performed very well. It is up 30,000% in all time, but also, as you could see, it's extremely volatile. You see a lot of peaks and huge drops, and that's something to keep in mind. Higher volatility, higher returns, but also greater risk. Ties back to the same concept. If you want higher returns, you typically have to take on higher risk. And as you can see, I also included that volatility is more useful for tracking price changes. Variance is more useful for, say, a quantitative approach. If you have like a quant model, typically they prefer variance over volatility, but for your average trader, volatility is more than good enough. So moving forward, we have standard deviation. What standard deviation is, it's a statistical measurement of how different the given sample is from the sample's mean. So for example, let's say you had 100 prices, and we're assuming is this is a normal distribution. So under a normal distribution, it actually follows the bell curve. If you guys ever seen this, very famous in statistics and outside of statistics. This is called the bell curve. So within one standard deviation, up and below and above, so plus minus one standard deviation from the mean, it's about the majority, 68%. So 68% of prices you expect to fall between, say whatever this price would be and whatever that price would be. So for this one, let's say the mean is 100 and each standard deviation is 10. So this would be 90 and this would be 110. So you would expect that the majority of prices fall between $90 and $110. Now, let's say if there was a price, say 150, 150 would be an extreme outlier, as it would be 5 standard deviations above the mean. And what standard deviations are telling you is, again, sigma. Sigma is standard deviations, they're interchangeable. But what it's telling you is how rare is this price in a way? How rare is this event? If it's, say, plus or minus 3, 5, 4, sigmas, that means it's an extremely rare event, and it tells you the probability of that event occurring. So for example, if you saw a price that was, say, 3 sigma above whatever the mean would be, say 130 in this case, that would mean out of all of the prices, say you took 100 prices, statistically it would be like less than 2 prices or maybe even one price that would be higher than that. So it's a tool to figure out, say, if you're trading something, you can use this and test within a time frame to see how rare that price is and see if you want to go long or short. So for example, let's say you see a super rare price, it's a plus 7 sigma, it's 170, the mean is 100, each sigma is 10. There is a very high likelihood that it may return to the mean. So you may short that because you say that's a plus 7 sigma. More than likely, it may return to the average. So I'm going to short that. Or let's say it's $50. It's minus 5 sigma from the mean, which is 100. So you may want to go long. That's minus 5 sigma. So more than likely, maybe it returns to the mean. But of course, keep in mind, this is a normal distribution for this example. Price and assets, they don't fall under a normal distribution. You would have to calculate the distribution type, which is again a lot more in depth and quantitative, and it's different. Options have different distributions, stock prices from one another have different distributions. The same stock can have a different distribution depending on day or time frame. So while it's useful, you also have to keep in mind it's something that you have to consistently calculate to be accurate. Moving on, we have beta. So beta is this really cool statistical measure. It measures the covariance. So what covariance is basically telling you is, hey, let's say you have a benchmark and you have another stock. So in this case, and typically they use the S&P 500. So let's say the S&P 500 goes up 1%. If you have a beta of 1, your holdings go up 1%. Let's say you have a beta of 0.5, stock market goes up 1%, you go up 0.5%. But also on the flip side, let's say you have a beta of 0.5. If the stock market goes down by 1%, you go down by 0.5%, which is why beta, you want it to be low. Low beta is actually superior to high beta. And the very simple explanation why is the lower the beta means you're taking on less market risk. The ideal beta is actually 0, and that's what a lot of hedge funds aim for. Hedge funds want zero beta, meaning they're taking on no market risk. So the market, it could go up or down. All they care about then with the zero beta is that the returns are positive. That would mean everything that they're generating is effectively risk free from the market. But you do have to keep in mind with higher beta stocks, you do see higher returns, but over time, here's a chart that shows that low beta actually outperforms the market and it completely outperforms high beta. And the reason for this is, again, high beta also works in the opposite direction. Let's say you have a beta of 2, which is considered high. If the stock market goes down by 1%, you go down by 2%. So imagine the stock market's fluctuating. One day it's down 3%, you're down 6%. So it is something to keep in mind. Higher beta does not translate to higher returns, even though you may see stocks have higher returns. Over the long period, low beta tends to outperform high beta. And now we have leverage. So leverage is when you borrow money to amplify returns. So leverage is very important to understand because it's an extremely useful tool, especially in trading, because most traders use some form of leverage one way or another. And the reason they do this is, say you're trading on a daily time frame. The stock may be moving at most 1 to 2% a day. Is 1 to 2% gain with a small portfolio going to translate to anything meaningful? The answer is probably not, unless you have a really big portfolio. So what a lot of traders will do is they'll leverage themselves. So they'll borrow money or they'll use other derivatives to achieve the same effect. So let's say you're leveraged, 2 to 1. So if you're leveraged 2 to 1 and let's say you're on the NQ, if NQ goes up, say 1% or 2%, you go up double that. So it goes up 2%, you go up 4%. Now that sounds very good, and it's important to understand how to use leverage. But on the flip side, let's say NQ goes down 2 or 3%, you're down 4, 6%. So it's a double-edged sword. You want to make sure you have enough leverage so that your wins are meaningful, but you're not taking on enough leverage, not taking on too much leverage as not to take on too much risk. If you take on too much risk, you could end up having, short-term fluctuation. It destroys your whole position. Let's say you wanted to take a trade, you're waiting on that trade, but in the meantime, let's say the stock moves downwards 1 or 2%, but you're over leveraged 3 to 4 times, and now you take a huge loss. And when it does move in the direction you want it to move, it doesn't move enough for you to recover that loss. That's something to be careful of. Also, when you have too much leverage, it could lead to a margin call. As you might have seen, there are people who have gotten margin called, meaning that your brokerage or whoever is lending you money will see that your account value has fallen below a certain point. They'll call you and they say, hey, we're afraid you're not going to pay us back. So we're going to tell you, heads up, put more money in your account, or we're going to have to liquidate you, meaning you have to sell your holdings to cover our position because you don't want to take on that risk. And here's an example of 3x leveraged. This is an ETF that follows the S&P 500. It has 3 to 1 leverage. Now, this looks really good on paper. Those look like huge returns. But one thing that doesn't show you here is these things can hit zero. Because it's 3x leverage, if the stock market drops by 33%, you hit zero. That's minus 99%. So it's one of these things where it's extremely risky, and it's something that most retail investors should try to stay away from, to put like as little money as possible. It is not worth it to put a large portion of your portfolio because it can go to zero. Let's say one day you wake up, stock market crisis, something drops 30 points, 33%, sorry, not 30 points, 30, 34, 33%, you hit zero effectively. So you do have to keep in mind it is something where, because it's extremely leveraged, 3 to 1 is a lot of leverage, it can hit zero. And finally, we look at how to actually analyze risk. So the real way that you want to analyze risk, and probably the best advice in this entire video, is you want to understand what you are trading. So it's really this fourth point right here. It's understand your approach. Is it risky versus safe? Do you want to take on more risk or do you want to take on less risk? And historically, taking on less risk is actually more beneficial, but you don't get those big wins with less risk. So it's something where you really have to ask yourself. Risk is also heavily asset dependent. For example, options are infinitely more risky than stocks. Beta for stocks is also a good indicator of how risky they are. So for example, let's say you want a low beta, low risk portfolio, you may look for stocks that are like 0.8 beta, 0.5, and you just buy a bunch of those, or even put in some bonds, which if you buy, say, government treasuries, they have a beta of 0, meaning that they don't take on any market risk. So it is important to keep in mind beta is a good way to very quickly tell if what you're trading is risky or not. And on top of that, you can look at the mean and use standard deviation to see where the price is. So let's say you look at Microsoft one day, let's say you take a time frame and you see, wow, this is 5 standard deviations above what it should be. That seems like either A, there's some really good news that justifies the price jumping up so much, or that the price went up way too much, it's overbought, and it may crash. And that kind of gives you some indication of how you could position yourself to take advantage of it. And understand leverage can be optimized. You have to use leverage in an optimal way, meaning the leverage that you take on has to be enough to where you could amplify your returns, but not so much where you take on so much risk that even small movements destroy your position. And finally, analyze your asset. Understand what you're trading. If you're trading options, know all the Greeks. If you're trading futures, understand what a futures contract is. And if you're trading stocks, understand what the company you're trading does. Knowing your asset will help you out much more than really anything else when it comes to trading, investing, all of that. You really want to understand what you're holding on to because it's not just something that exists on, a brokerage or a screen somewhere. These are real assets and they have real implications. They could be a commodity, it could be a company, it could be an options, derivative that, a hedge fund wrote that you could read and try to understand what they were doing with it if you can understand the Greeks. So please analyze and understand your assets and what you're trading. And that'll be it. Thank you guys for watching. Subscribe for more.